morning, everyone. My name is Jim Codney. I'm National Sales Director here at Western Marketing. First of all, thank you very much for joining us. As a few of you probably saw, GoToWebinar does take a little extra to get in. So I'm going to just give us about 20, 30 seconds for a couple more people to hop on. I'm going to put myself on mute. And then we will be respectful of your time. We'll get rocking and rolling with this presentation. So give me about 20 seconds and we will get going. Thank you. Well, all right, everyone. Again, for those of you who just hopped on, my name is Jim Codney. I'm National Sales Director here at Western Marketing. First, I want to thank and congratulate you for taking some time to invest in your business. It is not lost on us that when you're sitting here listening to great care with an innovative product that you aren't out at appointments making money and putting food on your table. So I expect that this webinar will give you some really good information. With that one housekeeping rule, we are here for you. Please, please, please ask questions. Any question you have there's no bad questions. Type them in the question box. We will get to them at the end of the presentation. If we don't get to your individual question, it's because you might have asked something that makes more sense talking offline, but don't worry, we will get to you and answer that question. So without further ado, I want to talk about this a little different. Usually I just talk about a good friend and a good partner carrier, which EquiTrust and Leon are. But that's where that ends with a lot of introductions for webinars. So, I've been in the business about 25 years, and constantly people come to me and say, hey, Jim, why don't carriers do something different? When will somebody innovate? When will somebody solve a problem? When will somebody give us something different to talk to our customers about? And, folks, that's honestly, without stealing Leon's thunder, that's what EquiTrust did with the Bridge product. So I'm going to let Leon talk to you about that. So without further ado, I'd love to introduce a good friend of mine, Leon Fitch, Regional Vice President with EquiTrust. Leon, good morning.
Hey, good morning, Jim. I appreciate it. And hey, appreciate the kind words as always. And honestly, it's a two-way street. I think that I've done a lot of work here in the last month or so, in particular, getting the message out, spending time in front of groups with Bridge. Obviously earlier this week and even the week before that, we met with different groups, and it speaks to your understanding of the problem, that we're trying to solve here. So appreciate that. Appreciate your partnership, and yeah, hopefully we have some time together today that allows the folks that are attending to go back to their businesses and work with their clients and ultimately help those folks. And then, hey, we're all for-profit businesses, and that's okay too, and help them generate a little revenue. So thank you for that. So we'll go ahead and jump in, guys. We're going to talk today about Bridge, which is our asset-based long-term care product. I spend a lot of time talking about the problem itself, which is the long-term care crisis. I do believe it's a crisis, as we talk about. There's 14,000, depending on what source you look at, 14,000 people turn 65 in our country every day. The greatest shift of wealth or transfer of wealth in our time. Along with that, the long-term care issue is one that's real, that impacts retirement, both from a financial perspective, but a quality of life, a quality of living perspective. So I talk a lot about that, and then get into the specifics of the product, of course, because we do believe we've got something here that is innovative, that is a solution for a lot of folks that are facing this problem, and I believe we've structured it in a way that it's accessible to a large group of people that face this problem, a large group of your clients, people you're talking to every day. So, but before I do that, I always kind of like to talk through, hey, why, that's great, Leon. Why should we do business with EquiTrust? I mean, I'm partial, right? Because I'm with EquiTrust. I'm part of the family here. But one of the things I really enjoy about our product suite and our approach in the market is that we really do try to make things simple. Okay. Simple, not just for from a product perspective for the advisor, but so when you're then having those discussions with the client, that it's simple and easy for them to understand. If they're able to understand it, they'll take action. If they're not, they won't, right? So we've got a really competitive suite of products, from bonus products. Our accumulation products right now are incredibly strong. Obviously, the long-term care product we're going to talk about today. So we've been rocking and rolling here, like most carriers have. For the better part of a year and a half, and we don't see an end in sight as we continue to look to bring innovative products to the marketplace. Rate transparency. So you guys sell a lot of Trust Me products, right? And with that trust, I think trust and transparency go hand in hand. We're one of only a couple of carriers that I know that are as transparent as we are in a couple of areas. One is with our renewal rate history. You can go look at our renewal rates for any product we have since inception and share that with a client. We do that intentionally because we want you to be able to tell the story. Hey, I'm asking you to trust me on a product that has a renewable rate potentially. Here's what EquiTrust has done historically, and I think typically that shows that we're not throwing a big teaser rate out there for a year, and then the next year or two that rate goes away, and you've got an angry client and a product that's not performing like you had hoped it would, and quite frankly, like we promised, right? So that's a big deal. When we talk about things like today, right, we're going to have a sales concept, a product. We're going to talk a lot of concept. We've got our inherited IRA program, our partial tax conversion program. Those two go hand in hand. And then, the topic for another day, but, we really like to bring concept along with product. And then a high level of customer service. I was kind of jokingly say, no carrier's ever going to get on a webinar or be on stage or talk to an advisor and say, boy, our customer service is not that good. But I can tell you that we kind of put our money where our mouth is, especially here in the last 6 months from an investment perspective. We process our business in a timely manner. We post those new business processing times on our agent portal. That's very unique and something we just started doing in the last few months, because we want you to know, hey, when you put a piece of business in, if it's in good order, how long is it going to take to get through the system? We've increased our new business processing staff by 42% here in the last few months, and heck, we're in the process of a home office remodel, and we've expanded into another floor of the building to accommodate some of those additions. So this isn't a short-term plan for EquiTrust. This is a long-term plan. We're making the investment to support that. So I think those are important things to know about who you're doing business with. All right, so let's jump into it. So you guys probably all seen, some version of this, right? But I like to start off to get us in the right frame of mind. Nothing can destroy a retirement plan faster than a long-term care event. Okay, so Tom Hegna recently was talking about our product in a presentation and said that long-term care is potentially a $1 million bomb dropped into a retirement plan. Nothing, again, can destroy that plan faster than a long-term care event, because if not planned for, that care then becomes a dollar for dollar proposition, meaning they have to pay every dollar of care, and typically, most folks have not, you'll hear the term self-fund. They have not intentionally self-funded. They may self-fund it now because they have no choice, but they have not planned to self-fund it. So we're going to talk about the power of the coverage ratio and the leverage you can get with the bridge product when we get into the product details. So I do this in reverse of based on how some of my colleagues do it, and not that there's one way that's better than the other. I just believe that it's good to get an understanding, quite frankly, to be professionally disturbed a little bit about what the issue is in the marketplace, and then we get into, hey, what's the product look like? How does it solve the problem? Okay, so we'll do that. We'll talk some product details. Then I've got a couple of sales opportunities, ideas, things that we share that as we see cases continue to come in, where are they coming from, right? And I'd like to share that with you, because that's the issue a lot of times with any product, right, is finding the money. So we'll talk about that. So this slide is titled The Reality. I honestly believe we should change it to The Problem, okay? Because this I does a really nice job of outlining the problem, okay? 90% of long-term care, traditional long-term care providers no longer issue policies, guys. Let that sink in. Now, do some math here with me. 7 out of 10 of us, okay, statistically, are going to have a long-term care event in our lifetime. 7 out of 10. I do not like those odds when they're not in my favor. Okay. Now you have 90% of current long-term care carriers no longer issuing new policies. It gets worse. Okay, 50% of the applications submitted are declined. So you've got this huge problem and a very narrow fix in the traditional long-term care space. Guys, we've got a problem, okay? You look at 66%, this number, I still always make the joke, I think this number's low. 66% of healthcare, 66% of people say that healthcare and long-term care costs are their primary worry. You know this, right? If you're talking to folks about their retirement, they care about 2 things that essentially that are coming up. Maybe a third if we talk legacy and leaving, money to the kids or grandkids, things like that. But largely, it's how is my money going to last long enough? Is it going to provide the type of retirement that I want, to live? And then number 2, healthcare and long-term care is a big part of that. 70% of the long-term care costs are absorbed by families. We're going to talk a lot about the family and the impact that it has on the caregiver here in a minute. And then 88% of folks 50 to 80 years old want to age in place. And then really what that says to me is they want to control how they age and where they age and have control over their care. The entire right side of this slide, I always say it's outdated the minute we do it, right? Because the inflationary pressures in the healthcare space are tremendous and they are not going away. So, if this slide's a month old, it's already out of date, and we usually use a claims scenario, and I'll show you one here in a minute that's 10 years down the road. And if you fast forward and look at what these are 10 years from now, they will not be the same. They may double, right? If not more. So, when you start to look at that comment that Tom Hegna made that, hey, it's $1 million problem in retirement, fast forward 10 years, double these, and then the average average long-term care event is 2.5 years. You can get to a big number really quickly. So I always say if you either take care of it or take control of it now by planning, or it will take control of you financially later. Okay, so this is the problem. This slide I think does a really nice job of talking about what's available in the marketplace and what are we facing here. And it's ugly. So the caregiver strains, I spent a lot of time talking about this. This one's personal for me. I've dealt with this, both with my mom and currently my wife with her mother, my mother-in-law, and we've lived it. And all 5 of these strains are real, folks. They really are. The time, 69% of family and friend caregivers report having to rearrange work schedules to provide needed care. Put yourself in these shoes. I always do this, with myself, and I think, you always want to tell a story. And, I've got 8 and 12-year-old boys. They're, as you can imagine, active as all get out. You should see our calendar. My calendar's got more personal stuff on it than work, and I've got plenty of work stuff on it. So it's, my wife's going in one direction, and I'm going in the other. And now you put another human being into that mix that needs to be taken care of. And guys, something goes away, right? It's free time. It's, maybe going to the gym or do, whatever you do. Your hobbies go away, when that happens. Then the financial strain, unfortunately, most Americans can't just put 26% additional strain on their income. And that's what you're looking at when you're caring for another person. You saw this on the previous slide, 70% of the costs are absorbed by the family, right? And that's real. I can speak to that personally. That is no joke. And guys, things go away, right? Whether it's your personal retirement or it's the type of vacation you go on, or you name it. Most folks don't have 26% extra laying around, for an event like this, and it's an unfortunate strain. Again, you take control of it now, or it takes control of you or others later. Right. The emotional, social, and physical demands are absolutely real. You worry about it all the time. You're not spending as much time with your friends. The physical part, I always just try to, if I'm sitting there talking to some folks in a room, and I'll just point at, a larger gentleman, and say, hey, Do you think your wife could pick you up and carry you to the bathroom, or carry you to the shower, or help you to a vehicle? No, of course not. It's physically impossible. So the physical strain is real and often overlooked. So this is why we should be having this conversation with our clients about it. It becomes, and have a little fun with it, but it becomes less about them and more about their family, guys. It really does. We don't want to be a burden to our children. Okay, most people are really concerned about that. And I'm going to talk to you at the end about two things that I think are really important, just ways to get the client to see and feel why they should be, thinking about how they're going to take care of this problem, right? When you start to realize long-term care solutions can be just as much about the family and friends as it is the client, right? And Bridge has really taken that, a three-pronged, approach to it. And most long-term care hybrid products that are out there are really only, a single prong. They've tried to generate a solution, whether it's a doubler or tripler or something like that, that they can generate some additional dollars that can be used for long-term care. Well, the reality is there's more to it than that, right? We want to be able to have the ability to protect and grow our assets. This is not a dead asset. When this money goes in, it still grows on the accumulation side. I'll illustrate that for you here in a bit. We got the long-term care coverage. This is a true long-term care product. The claims are paid tax-free. We have a qualifying long-term care event, and we've got our wellness program. I won't spend a ton of time talking about that today. Quite frankly, it's probably a presentation all in itself. But boy, it's really two focuses. One, we want to push claim down the road as long and as far as possible, right? A, because we just want people to live healthy, okay? And B, the longer we're able to push claim down, the better this policy, the more it will grow, and the bigger benefit that it will provide, your client down the road. So, when you provide those three things in one product, that's pretty powerful. So the highlights, or as we, kind of the main key points that we'll talk about here, right? This product's built on a fixed indexed annuity chassis. Think income product. You've got the accumulation bucket, and then you have your income bucket. Well, instead of the income bucket, we've got the long-term care coverage ratio bucket, and they act totally independently. Once the product is put in place, it's a flexible premium product. The only distinction there is all year one premiums will take advantage of the coverage ratio that establishes the benefit base, which I'll show you here in just a second. And then you can still put premium into this product after year one, but then it's just dollar for dollar to the benefit base that would not then get the coverage ratio benefit, but still makes a ton of sense, because remember, these claims are paid tax-free. So a couple of scenarios where that makes a lot of sense. We've had some really creative agents, find ways to fund this over time after that initially starting the policy. So some very simplified underwriting, and that is true guaranteed approval. Okay. I always get the yeah, but, Leon. There is no yeah, but. We could have somebody that's in a facility today. We will approve them with our secure issue underwriting class. And it's the best worst case scenario in history for that person, because they're still able to take advantage of some leverage on their dollars, and their claims dollars are paid tax-free. We'll talk about why that's important a little bit later. A true indemnity claims process. What that means is, as soon as we have a qualifying event, okay, so unable to perform 2 of the 6 activities of daily living, or severe and permanent cognitive impairment, guys, that's more common every day, right? You guys hear, folks getting, the dementia, Alzheimer's, man, it is a big deal. So once that happens, all we do is take the benefit, wherever our benefit base has grown to, divide that by 60, and we make those payments directly to the client if we're up to 5 years. It's a 5-year payout. That's why we do it by 60, obviously. And they then decide how they care for themselves. Okay, they have control over how and where they get care. No chasing receipts down, no pre-approvals, no all the ugly stuff that can be make healthcare in general hard to deal with on occasion and confusing for people. Nothing is more simple than a cash claims process, right? You qualify. Here's what you're going to get every month for the next 60 months. Okay, simple. And a true, completely digital underwriting process. Okay, it's a short 20-25 minute video interview. Well, they essentially demonstrate their mental and physical, mental acuity, physical dexterity. You know, almost immediate underwriting decisions. So no doctor's exams, no RX checks, nothing. Okay, that's the underwriting process. So very simple and just a innovative way to determine someone's underwriting class. Cool note there: 66% of our folks that go through underwriting do get preferred, and that just a percent or so every month, but mid 60% are getting preferred right now. So it's not some unicorn that someone's out there to get preferred. So let me show you a scenario here. This will do a good job of illustrating kind of how the product works. If you're like me, pictures are good, so the visual side of this is nice. So David's your typical 65-year-old retiree. He's got he's single. He's got 3 grown children. His objectives are like most of ours, okay? He wants to live independently as long as possible, preserve his assets. He does not want to be a burden to his children. For me, that would be the number one, okay? And I'll talk about that at the end. And I mentioned I've lived that, right, as a son, and now as a son-in-law. So David has an initial premium of $100,000. Minimum premium entry point is $50,000. David has $100,000. He's preferred. He's a healthy guy. So his age is 65. A preferred underwriting class is 315% coverage ratio. What's that look like? You can do the math pretty easy. We do it that way for a reason. $100,000 times his 315%. And coverage ratio gives him an initial benefit of $315,000. Okay, so his 100 is worth $315,000 from a long-term care perspective. Why would you ever self-fund it? Why? Right? The math is just so much better doing it this way. So let's talk about what it looks like for David at claim time. Okay, so at claim time, like I said, we usually use a 10-year period. I'll talk to you about some other benchmark times that we want to be aware of, and as you're explaining it to understand. But after 10 years, so David's his new benefit base is $383,900. So just say a little shy of $384. How did we get there, Leon? He only had a benefit base of $315. Well, he got to take advantage of 10 years of the 2% guaranteed annual growth. Get a 2% guaranteed annual roll up on this. Okay, so very powerful over time. That is actually for up to 20 years. So it's for up to 20 years or claim. He took part and participated in the Never Stop Wellness Program. Right now, we're still relatively early in this product. It was introduced, I believe, in November of 2022. So we're just now starting to see folks go through a full cycle. With the wellness program, we use the number 5 to 8% as really a good target for what someone can add to their benefit base, and those are real dollars. I mean, this is 27 grand that he was able to add to his benefit base. So his total benefit base at claim was a little north of $400,000, so $411,205. So here's that 60-month math. Divide that by 60. He's getting paid out $6,853 tax-free to use towards his long-term care and healthcare needs. So pretty powerful. You see what that $100,000 turned into, right? So let's look at it in picture form. This is always good for me. This is kind of how I started putting the pieces together when I was learning this product, right? So he's got his initial premium. There it is. That's his $100,000. Bang. That turns into the 315%. This is where we talk. Okay, Leon, how are you guys doing this, right? Man, this seems, with the secure issue and guaranteed approval, well, it seems like it'd be tough to be profitable. There is a vesting period, a 4-year and 1 day, essentially, vesting period. So year one, you're 20% vested immediately. So what vested in what? And that is the net amount at risk. So the difference between the $100,000 premium and the $315,000 benefit amount, so that's $215,000. So day one, they're automatically vested in 20% of that money. Okay, year two, it's 40%. Year three, 60. Year four, 80. Day one of year five, they're fully vested, and now you could literally just remove the vesting period. It's over. That's why part of the reason why the wellness program is so key. We want them to live as long and as healthy as possible for obvious reasons, but we want to get them outside of the vesting period if we can, so they can take full advantage of the coverage ratio. So in this scenario, or this illustration is index credits on the accumulation side, grow the accumulation value to $184,000 and some change. I mentioned the 2% compounded roll up for 20 years or until claim. His was 10 years, so 2% that rolled him up to 384 essentially. Then his wellness credits took him up to the 411,000. So that's kind of what it looks like side by side. You know, when you take a look at, you know, how these two perform separately. So the key thing to get here, I get this question quite a bit. Yeah, but Leon, what happens with rates, you know, plummet? There's no impact. The left side has no impact on the right side. The only correlation is when claim is paid, that 6,000 and whatever it was per month that his claim that his benefit base created, as that's being paid out, it does reduce the accumulation side dollar for dollar until it's zero if he's on an extended claim. But if he dies early, you know, if he were to die early in claim, say 6 months in, right? Well, he had only spent 36 grand of that money. You know, whatever's left over here on the accumulation side is then paid out in the form of a death benefit. Key difference between that and typical long-term care, there's typically no very little or no residual value to that. So, you know, it's kind of a have your cake and eat it too product. It really is. So some of the product details, I've mentioned a few of these already. Issue age 55 to 80. You know, some really cool concepts with folks that are still in the workforce that are high earners, maybe have a bonus. I'll talk about the annual bonuses. I'll talk to you about that later. Minimum premiums $50,000 at this time. It's all non-qualified dollars only. We are considering, and our actuarial folks are looking at and evaluating, hey, what do we do here with it to get some qualified dollars available to us? It would be a separate filing, a new product, but more to come on that as we look at Bridge 2.0. Flexible premium product, as I had mentioned, and then like most of your FIAs these days, right? 10-year surrender charge, 10% free withdrawals after year one, so still has that flexibility. Several index options. Right now, 60+% of our dollars are going into the fixed account that's paying 5% right now. You can see the rates, and that's the beauty of this product. It's still a reasonably competitive financial product, FIA, on the accumulation side. And when you compare that, and I'll show you that here in a bit, to some of the other hybrids in the market, we blow their doors off. I mean, we really do in a lot of areas. And part of that is because of the fee structure of this product. So right now, 5% 1 year interest on the fixed rate. You know, your S&P 500 1 year point caps a strong 10%. So you can see those. I mean, lots of options and, you know, an ability to, you know, perform on the accumulation side, and, you know, but still have that leverage on the long-term care side. If you haven't already, guys, you have to visit the microsite. This is how I learned it. This is a world-class tool. It's got everything you need to learn the product, market the product, and illustrate the product, apply for the product. Okay, talk about underwriting. It's got everything you need. Okay, and it's a one-stop shop. You can order marketing materials from it. You hit whatever state your client's in. You hit a drop down. It automatically pre-fills the available, approved, compliance-approved underwriting material. It really is a powerful tool. And again, how I learned it, I think it's a sales tool. You can use the calculator in a client-facing manner and really just adjust how much the premium they put in. They can see on the right-hand side the impact that has on their monthly payout. You can do it a couple of different ways, but that's how I think that it's really most powerful. You can create a PDF to send to them that's really customer friendly, that, you know, does a great job of simplifying the entire process, you know, start to finish. So this is a tool that you have to be taking advantage of. And if you're not, you're missing out, right? You really are. So we are partnered with Assured Allies on the underwriting. They are our partners on the underwriting and the wellness program. So there's some really nice synergy there, you know, when you have those two things, you know, being, you know, kind of put together and worked with, you know, by the same company. Because so they're doing the underwriting, but we're trying to keep folks healthy, right, for as long as possible as well. So that's a nice benefit to have. Quick decisions on the underwriting. Again, 20-25 minute video underwriting. The agent will get an email within 5 to 10 minutes with the underwriting decision. You can go through underwriting before you fill out an application, which is unique and I think really nice. So it gives you, you know the answers to the test before you start filling out the application. 100% guaranteed approval, no medical, no prescription, no blood draws, no doctor's records, none of that. 5 application questions, and you know, we're off and running. Okay. I mentioned earlier that 66%, or so, you know, give or take, depending on the month, but mid 60% folks that go through underwriting are getting preferred. Hear what I said there, that go through underwriting. Not everybody goes through underwriting, right? If we know that they're disqualified from preferred or standard, but they're an automatic secure or guaranteed approval, they don't have to go through underwriting. Okay, so you know, we just automatically place them, you know, in secure issue. If they answer yes to one of the first 3 underwriting questions: do they reside in a nursing home or assisted living facility? Do they need assistance with any of the ADLs, or are they in a mobility device, a wheelchair, a scooter? If the answer yes to any of those, they automatically go to secure issue. So you know, we can, you know, really know where we stand before, you know, we get into the nuts and bolts of the financial side. I've mentioned most of this. The one thing that I like to make sure people understand is that you cannot put more premium in. I'm sorry, I'm beating that up. You can never have more than $1 million of long-term care coverage in year 1. That's the max. It can grow past that, meaning that someone couldn't put 500,000 into it at a 300% coverage ratio, because obviously that would take them north of the $1 million. But it can absolutely grow to north of $1 million, and boy, we love to see when that happens. So yeah, so just understand that little idiosyncrasy. Hey, how do we price it? You know, what do the charges look like? So really quickly through this, so 1% first year premium load, $100 to the Never Stop Wellness Program. That's automatic to year 1, but can be opted out of after that. They're not using the wellness program. Again, I would really encourage folks to take part in that wellness program. It's going to pay them back far more than $100 a year. And then how's the long-term care rider? That's the big one that we get the question, right? It's based on, as I met, net amount of risk. You know, it has nothing to do with the accumulation value, which is key and hugely important and advantageous to the client. And I think when you're selling it too, right? Because it keeps them out of that world. Like, what if, you know, this thing can blow up? Nope, that won't happen. Okay. So lower charges over time comparatively to other hybrid products, right? Because it's not based on, you know, mortality like a life product. Is truly based on that net amount at risk. How does it compare competitively? You know, so you look at averages on the New Care, One America product, 2.44, 4Care, you know, 1.57. How's 0.51? How's 51 bips sound? That's reasonable. By the way, it's less, and I'm going to show you that here in a second. So what's that look at? What impact does that have on cumulative change, you know, charges on the net rate? Okay, so you see where we're at. That's where what I just showed you. You know, of course, it has an inverse effect, right? You're going to have a better net rate if we have lower charges. So that's pretty powerful. I think this is cool as well. We're the only ones with a secure class, a guaranteed, true guaranteed approval. But look at the average cost when they're with the most likely are least healthy folks, right? The folks that are at secure or guaranteed issue. Well, it's actually cheaper because the net amount at risk, the premium in relationship to the coverage amount of the leverage, is a smaller number, so the fee is less as well. So it's actually less from a fee perspective on our guaranteed issue, when I think most people would assume that it's more expensive. What's covered? This is just a snapshot. You can pull the full grid right off of the microsite, but you can see a preferred 55-year-old get up to 325%. I mean, wow. I mean, that's a powerful number. Worst case scenario, you get down to a 130% on a 75-year-old who's guaranteed approval. Well, that's pretty good, right? You're getting, you know, $1.30 on every dollar that comes out tax-free. That's hard to beat. The wellness program, I'm not going to spend a ton of time here. I've talked a little bit about it. Essentially, you're assigned a coach. They put together a plan. The client follows that, and then every 2 years, we're going to take a look at that, and we're going to score it. And then they're going to get applied some credits to their wellness program. 5 to 8% typically is what we expect someone that's fully participated. You saw that David had added north of $27,000 to his total benefit base. Sorry. Sales opportunities. A couple places we're finding some pretty big sales right now. You know, so last week, you know, we averaged a little north of 110,000 per case in bridge, and that continues to tick up. It's because we're finding bigger cases. A lot of these are coming from 1035 exchanges. So think about a parent that bought life insurance, you know, that that believed in a permanent policy, that had a life insurance policy that had some gain in it, but heck, the kids are out out of school or out of the house now. They really don't need that life insurance. They've got it. It's got some growth. Well, they cash that out, right? They're going to pay taxes on the growth, right? So, well, if we 1035 that money over to a bridge contract and then they go on claim, how do the claims come out? Tax free. So they have never realized the taxable event on that policy. So we're getting a lot of folks, hey, I'm just going to take that money that I solved another problem with earlier at a different stage in life, and I'm going to move it over here and solve the next one that I have. And we've seen some really nice cases come in, on 1035s from old annuities and old life insurance, underperforming in old annuities out of surrender, and then, like I just illustrated, some permanent life plans with significant cash value in them. And you guys know it, they're out there, right? They're out there. And then, your typical liquid assets that folks have, or soon to be liquid, hopefully, the money market, checking, savings, CDs. You get a lot of conversations with folks that have some CDs coming available, and that's, where that flexible premium piece to this really helps out. And then annual reviews, and you guys are all doing them, guys. What you want to do on the annual review is just kind of tweak it a little bit. You got to, if you're not already doing this, we got to have a pretty passionate conversation about, this product with people and this problem. Actually, the problem, then the product will come in later, and how you solve that. I'm gonna tell you kind of how I would do it, and what. I've gotten some pretty good feedback on, just boiling it down to two things for them at the end, and I'll do that here in a minute. Again, in summing it up a little bit, built on an FIA chassis, flexible premium, guaranteed approval. The wellness program is a huge add. I believe it's a post-sale conversation and value add. And then the indemnity claims process. I think that's right up there as important as the guaranteed approval, portion of this. I think that's as important when you start looking at it from a client perspective than a completely digital process. So to sum up what I said a minute ago, right? Tell a story. Okay, you likely have one. I've given you two in my lifetime, and I'm not that old. Okay, and I've got two. I've gone through this twice. Okay, currently going through it. 7 out of 10 of us are going to go through it. And guys, it comes down to this. If you could see me, I'd show you a picture on my phone. It's myself, my two boys, and my wife. And and why do we keep pictures? Why everything at Facebook, right? It's hey, a year ago today, this is what you did, or boy, look at your kid 7 years ago. It's memories, right? So look, I want the lasting memories of my two sons to be. In the picture I show is me. I coached my son's youth baseball team, and I try to coach as much as I can. And those are the memories I want them to have, gang. I really do. I want them to remember Dad playing hoops with them in the driveway down here in the basement, playing ping pong, going to their games, coaching them. Those are the memories I want them to have of Dad when I'm gone. Okay, not taking me to the toilet. Okay, not dragging me to a shower. Okay, and the other side of that is selfish. I want to maintain my dignity. I don't want that. Okay. I want to be able to have control of my care. I don't want to put that burden on my children. And selfishly, I want to do that partially because I want to maintain my own dignity, as I age or likely have a long-term care event, as 7 out of 10 of us will. Okay. So again, it's a have your cake and eat it too product. You're going to have some nice growth. It's not a dead asset on the accumulation side. So if you're one of the lucky ones, you're one of the 3 out of 10 that don't have, a long-term care event, great. You've got this nice asset that's grown that you can leave for your beneficiaries, and you're going to feel pretty good about that. But all along, you've had the protection and the planning in place in case you've had a long-term care event. So, we'd frame that conversation, from a caregiver / legacy perspective, as I think I've made pretty clear on how I feel about that. So, with that, guys, that is it. I'll see if Jim, if you had anything to add or that I missed, and we can answer any questions that come up.
Yeah, thanks, Leon. Folks, first of all, now is a great time to add questions. We already have a few questions in, so I'll get to those here pretty quick. I do want to drive a couple things home that I think are, table stakes or imperative. First of all, you may or may not know that there's states that either currently require their residents to have LTC, or there's 13 and 19 states, depending on what report you look at, that are considering requiring that. So, Leon, correct me if I'm wrong, but the bridge product does satisfy that requirement, correct?
It does. Yeah, this does. It does satisfy. 'Cause you've heard me say the term. It's true long. It qualifies as true long-term care. It satisfies the Pension Protection Act. So yes, it does. You know,
Yeah.
we're
So
actually we're actually doing some work to there's typically it'll list products or carriers. So you can find websites that'll list that. And I know we've been on a few of those. We're trying to put together a marketing piece to lead folks to that. So more to come on that, because that question does come up, and it's going to come up more and more.
perfect. And folks, that can be a big deal, right? Because you're not only solving the LTC gap with your clients, but that product is on a regular index annuity chassis. So again, if they're one of the three that never use it, they're still working, they're still in an index annuity growing their retirement funds. One thing that we love about Bridge, other than that it's a true LTC benefit, and we're seeing carriers leave that market, both on the traditional LT side, or like Gillico had a product and they pulled out last year, is that none of them have a guarantee issue product. So that's really important, so you can sit down with a client or talk to a client over the phone and not worry if they're a triathlete. They're going to qualify for something. The only difference is going to be the coverage ratios with this. So keep that in mind. And the last thing before I get into the
Hey, Jim,
questions, a lot of,
yeah,
yeah,
yeah, on
go
that
ahead.
point, right? So I think that's such a key point, because it takes away some of the angst, not just from the client, right, but for you as the agent or advisor, right? Because
Mm-hmm.
you get into products that require you to qualify for them, and there's always that. Well, what if they don't qualify? I've wasted my time,
Right.
wasted. I probably soured the relationship. It's such a comfortable conversation. You have an answer for them, and if you've got folks that have been declined, and you've had this conversation, and you've had folks that have been declined, for long-term care, that's where, start there. What a great call to make. Hey, by the way, remember you told me you got declined by a company XYZ. I've got a solution for you. Call me back, right? That's a cool phone call to make.
Yeah, no, I completely agree. And the last point I want to make before we get into coverage is how to start the conversation.
Mm-hmm.
One of the things is to just ask what they have in place to cover the potential $1 million bomb that could hit their retirement savings. And then, so if you ask that, just shut up and see what they say, because you're going to make them uncomfortable. And we aren't trying to scare anybody into buying a product, but that's a realistic, question to ask. And if that's a little too direct for you, just ask, hey, what do you have in place in your health insurance to make sure you aren't a burden to your spouse, your kids or grandkids should a long-term care event happen? Do you want to stay in place and be able to make that choice? Those things are less, in their face. So it depends on what works best for you and your sales style. But those are questions that I think are legitimate questions you can ask your clients. So,
Yeah.
just more to come. And so, Leon, we've had a couple of questions. First of all, John wanted to briefly have you talk about company financials. So I don't know if you want to hit your AM Best rating and talk about that really quick.
Yeah, so this comes up from time to time, right? We're B double plus, and I know that there are especially on the BD side, that can be a problem, for depending on the company. But all I can tell you is this. So first and foremost, we've got our letter of financial condition that's out on the website. You can read it. It does a really good job of talking about our ratios and all the financials and the things that are important for a financially strong company. I tell people this all the time. You could do a blind taste test and look at our financials side by side with another company that is an A-rated company, and we win in a lot of areas. So there's so much more to the ratings, okay, than just the pure financials, okay? So that's first and foremost. EquiTrust is in an incredibly strong position right now. I think when you start to see the investment that they're making as well. So outside of just the financial data, right? Look at the story of the company. With our ownership and the investment that they have made, and the increased staffing and product innovation. companies that are not very, very healthy in a place to make those investments, they're not making those investments. Okay. So just from, hey, what do you want to be on this team? And I had to ask myself that question when I joined EquiTrust, and it was an easy answer for me, because I think when you're making a decision from an employment perspective, right? Hey, do I want to take my career there? You have some of the same conversations that you would as a customer, right? Because both of those are financial decisions. So Jim, I can send you a couple. We got our awards 50 as well. We've been named to that list. I think it's either 7 or 8 years in a row. So I feel confident in where we're at, and quite frankly, I do believe that if not this year, next year, that you'll see us earn that A rating. You can pull multiple third-party evaluations that have our outlook as positive. So yeah, you can feel confident, that not only is EquiTrust in a great place today, but we'll be here to stand behind not just Bridge, all of our products for years to come.
Perfect. And John, or any of you that have questions on that, feel free to reach out to us. Right before we end, I'll give the number to our office, and I can speak about personal experience. I worked for a different carrier. We were B++ for a while, and AM Best wanted diversification in product line. So we diversified a little bit in product line and immediately got an A- rating. So it's not, AM Best ratings are not just about assets and liabilities. There's more to it. And frankly, folks, just to be very transparent, if we didn't think EquiTrust was financially strong, we would not be having them on this presentation today. But it's definitely a valid question, because I understand the importance. The next question was, can a client transfer funds from a retirement account to the bridge account? And if so, does it result in potential tax liabilities? So, Leon, if you don't mind, I'll answer this in as simplistic way as I can. And if I miss something, please jump in. So basically, folks, as long as that retirement account is a non-qualified retirement account, we can do that. And actually, it reduces potential liabilities from putting that money in like a traditional index annuity that doesn't have the long-term care. Because if your client goes on needs long-term care, they'll lose 2 ADLs or lose their mental faculties and qualify for a true long-term care event, they can now take from their retirement account. And again, annuities are last in, first out for taxation. So they can take that benefit from this retirement account, again, non-qualified. And if it's a true qualification long-term care event, those long-term care payments are not taxable. Leon, anything to add on that?
Yeah, no, right now we can only accept non-qualified dollars into this product. So if you did have a qualified plan, you would have to, that person would have to take the tax hit, then put that money into this. I've had some people make the argument that depending on their personal tax situation, that, that could make sense if they're getting getting a 300+% leverage. I'm not an accountant. I don't talk a lot about that. I just know that our product takes non-qualified dollars. But the fact is that, when it comes out tax-free, that's also, I think that's the power, of that conversation.
Yeah. And perfect. If you have, Marjorie, if you have more questions on that, feel free to reach out individually and we can have that conversation. The next question was about guarantees that LTC charges aren't going up. And what if assets don't grow as expected? And I think, John, the key to that is that's why getting a plan in place today is more important than ever. Those costs are going up. And as Leon said, those expenses are going up maybe weekly or monthly. So you need to get a plan in place. Now, what Bridge guarantees is their coverage ratio, and their payout is going to be whatever the client qualified for. The expense when they are on claim may be higher than it is today, but the actual Bridge product payout will be what was guaranteed in the illustration. So it won't blow up. It'll actually give them coverage that they qualify today, and hopefully they have a good ratio and will be able to handle some of those expenses. Leon, anything to add on that?
No, that's it. And I always try to be very clear. If they're buying this product, they should be buying it because of the long-term care, right? Coverage. It's a nice to have that the accumulation side, especially in today's market, is illustrates and grows nicely. Because if you look at some of the competitive products, that is not the case. The way they're structured. So to me, that's that have your cake and eat it too that I've mentioned, because there is no correlation. So if worst case scenario happened, we just, boy, we're getting killed, and the cost of the long-term care goes up, it still has no impact on the benefit based side. No impact. They are totally separate. Would it have an impact on the net return on the accumulation side? Yes, it would. But we have no reason to believe that that's actuarially, that's not how we feel. Even if the market shifts, which it will, right? The market will change. It always does. But if that happens, it doesn't matter, because the person bought this product for the long-term care side, and they can feel really good to know that long-term care benefit base is guaranteed, and so is the 2% roll-up. Contractually guaranteed. So, that's the point here that you got to drive home with the client, that those two buckets are separate from each other, right? They really are. There's no impact on their long-term care benefit.
Perfect. And last but not least, there was a question about illustrations. If any of you have a client you're thinking of, and you want an illustration, or have any other questions at all, please feel free to either call myself, I manage our life and annuity team, or ask for somebody on our team. Our number is 800-852-7152. Again, 800-852-7152. And there's a question, last quick question about morbidity charges, and again, those don't affect the payout of the bridge. Those are costs associated with long-term care, but they will not impact at least the payout guarantee of the bridge products. Whatever your client qualifies for, keep in mind when they go on claim, whatever year they're in, that's the monthly benefits they're going to qualify for, and it doesn't matter about long-term care costs or morbidity expenses or any of those things. What EquiTrust is saying is, if you buy it today, whatever it illustrates when you qualify and what's in the client's policy, that's what they're going to get. So I understand the questions about expenses and stuff because of the environment we're in, but it really has nothing to do with what EquiTrust is guaranteeing. They're guaranteeing, if you buy it today, that's how they're going to pay. So I think, just keep that in mind. Again, if we need to have some of these conversations, if you have other questions, we are happy to answer those. Just call either myself. Again, my name is Jim Codney. I'm National Sales Director here, or ask for somebody on our life and annuity team at 800-852-7152. And with that, guys, we're almost an hour in, and there's been some great conversation and questions. So I appreciate you being interactive and your thoughts on this product. Leon, thanks again to you and the team at EquiTrust, not only for being great partners and friends, but actually looking for the problems out in society and how we can address them and solve them. So with that, everybody, thank you very much. Have a great day. Take care.
Thank you.